Good afternoon, everyone. Thank you very much for coming. This event is on rethinking financial valuations through the integration of sustainability considerations, hosted by the International Institute for Sustainable Development. My name is Ben Payton. I'm a freelance journalist and also a special projects editor at Responsible Investor, and I'm very pleased to be your moderator for today's session. Now, if we can start with the basics, the reason for this session is that historically, when valuing companies or making capital allocation decisions, investors have focused solely on financial returns. The sustainability implications of investment decisions, the carbon emissions, the effects on ecosystems, the costs and the benefits to workers, and the impacts on local communities, all the other so-called externalities, both positive and negative, have not historically been factored in. And that's despite the fact that companies that cause environmental damage or are implicated in negative social impacts are increasingly exposed to direct and indirect financial costs, be it in the form of fines or regulatory penalties, divestments or exclusions. So in more recent times, investors did start to pay attention to environmental or social issues, and that often started through approaches based mainly on excluding certain sectors or certain companies from investor portfolios. However, more recently, investors that have defined themselves as impact investors, and also more broadly investors that are seeking to integrate sustainability imperatives into their portfolios, are now starting to take a more holistic approach, so that valuations are influenced positively and negatively by a company's sustainability credentials. So in this session today, we're going to discuss the importance of integrating those sustainability factors into financial valuations. We're going to look at the current state of play around this, and we're going to review some of the innovative approaches that financial actors are taking on sustainability integration. We'll begin with a discussion among our panelists, then we'll have some time at the end where you can put your questions to the panel. So if we can start by introducing the panel. To my right, we have Jeroen Bos, who is Global Head of Sustainable Investing at Credit Suisse Asset Management, and also a member of the Investment Committee of the Rail and Public Transport Pension Fund in the Netherlands, a board member of the Adopt Rainforest Foundation, and a member of the CFA Institute's Global ESG Working Group. Then Morten Siersted. Morten is the founder of F1 F9, which is a company specializing in the financial modeling of infrastructure projects. He also recently joined the Sustainable Infrastructure and Sustainable Finance teams at the IISD. David Ujoki, Sustainable Finance Lead in the IISD's Economic Law and Policy Program. David is an expert in advising public and private investors, government officials, and financial market participants on how the allocation of capital can be better aligned with sustainability objectives. And last but certainly not least, Corinne Nambla, who is an entrepreneur, director, and consultant specializing in financial issues across capital markets, investment banking, project finance, infrastructure, and venture capital. Corinne was a former CEO at a private equity infrastructure fund, a G20 infrastructure observer, and a member of the OECD long-term infrastructure panel. So I'm going to begin now by asking each of our panelists to share some initial thoughts on this topic. Jeroen, if we can start with you, what stands out for you here as the most important things to consider around this subject?
Sure, thanks, Ben. So for me, sustainable investing, ESG integration is simply a more complete approach to investing. So looking at environmental, social, governance aspects, those can have an impact on the long-term success of a company. Therefore, their long-term cash flow generation, the long-term profitability, and therefore its valuation and its share price or security performance. So from my perspective, it's actually fully in line with fiduciary duty to integrate environmental, social, and governance aspects in the investment process and basically leads to better decisions. So where possible, I think you should always do it. If you don't do it, you could actually claim that you're not fully adhering to a fiduciary duty. So from that perspective, really important. Of course, in practice, it is not easy to do. There are data challenges. ESG scores have challenges as well. So very important, not easy in practice, but we'll discuss those challenges and what can we do about it as well during this panel, I'm sure. Thanks.
Great. And David, would you like to share some thoughts?
Yes, I mean, thank you very much, Ben, and thank you all for coming to this session. So I certainly agree with what Jeroen just said, that actually all investors should integrate sustainability considerations in how they allocate capital, because I believe that it can decrease risks and it can also have a positive impact on financial returns. So just I want to kind of clarify, just to make sure that we are on the same page. So when we say ESG integration, we mean like sustainability integration as well. So basically, we use these two terms interchangeably in our context for our discussion today. So just to kind of show you some examples why we think that actually sustainability considerations can have a financial impact. So for example, if you're looking at a company who is for example, in the automotive industry, and then a financial analyst should also consider how that company is positioning itself vis-a-vis the electrification trend. Also, companies that have a lower sustainability footprint or lower environmental footprint are likely to actually do, it's likely that they will not have too many monetary fines or reputational damages when it comes to environmental shortcomings. Same thing when it comes to the S. So the S can also, like the social part, the social side of ESG, companies that are equal opportunity employees, for example, or they actually respect employees' rights. We have much lower turnover, and that's why higher valuations as well. So, but these are just some examples to show you that there is a correlation between sustainability and financial performance. But there are actually many empirical studies that actually prove this point. What we are seeing as well, that I'm sure you have seen these meta studies that actually look at 2,000 empirical reports in this area, and they actually 90% of these 2,000 studies show that there is a positive correlation between financial performance and sustainability, or a natural correlation. But certainly, it's not a trade-off between sustainability and financial performance. And then at the International Institute for Sustainable Development, we are also looking at this topic. We are also integrating sustainability considerations in financial valuations in the case of infrastructure. And but I will talk about this later today. Thank you.
Thanks, David. And Corinne, any thoughts from you?
Yes, and if I may, I'll position myself as a dinosaur, if I may, because I was an investment banker in the 80s in New York, and then when I recently exchanged information on outliers and black swans and perfect storms with my oldest son, he looked at me and I said, we had to deal with commercial paper rates at 21% in New York at those times. And he said, Mom, you're a dinosaur. And I said, yes, I'm a dinosaur. So I'll give you a helicopter view of a dinosaur on these particular issues. And if I may, I will, obviously put this conversation in perspective with what we've heard during the summit and the opening ceremonies about the perfect storm of compounded crisis. We've heard some bullshitting, pardon my language, about ESG and norms and things, and we've also heard some pushback, clearly. So the word that will stick with me is challenge. ESG, rethinking financial valuation is a challenge for the market. And my question really is, are we capable of leaving our comfort zones based recently, or up until recently, on value for money and related embedded metrics? these metrics, as we know, are used for asset portfolio management and by portfolio managers, hence the short-termism, and we'll come back to that. But what really struck me was the focus on fiduciary duty, as highlighted by Patrick Audier. And I will be reading a little bit later a recent statement made by the governor of Florida, Ron DeSantis, who's positioning himself as the next possible president of the United States. And he points out at ESG as an ideological bomb. So I'll, more on this. So my question again is, are we capable of, moving from VFM, value for money, to value for people? And as an expert, former expert with the UN, we coined this expression around PPPs, private-public partnerships, and we named them People, Planet, and Profit. Now, interestingly enough, when we talk about financial valuation when it comes to ESG, this notion of profit is almost, the elephant in the room. Nobody wants to talk about it. Interestingly, I looked at a recent PwC survey, and these are 2022 interviews, and the question was, if there is, because of applications of ESG norms and metrics, less than 1 basis point in terms of returns, the response from all the managers were 80% say no. We won't incorporate them. PwC Research 2022, interviews of all CEOs. It's an American piece of research, but that's the stats. These are the stats. So we do have a problem on our hands. So clearly, I want to also, change this. Does ESG rhyme or not with profit? And I think that most of the work that has been done here in Switzerland, and in particular by SSIF, shows that data demonstrates that ESG can rhyme with profit. And I think that's really what we need to focus on. And I think that the last stats show that more than 500 billion have been invested here in Switzerland, and they can't be wrong. So I think we need to put this in perspective. The other thing that also I question is status quo an option, i.e., not doing anything or hiding behind our little finger and pushing back, as we've heard some big players like BlackRock, basically pushing back and saying, oh, we would lose our AAA rating and no, pension funds won't allow it. It's wrong. Certainly not, because having worked with some of the leading Canadian pension funds, I can assure you that they now have pensioners, future retirees, sounding platforms, and basically these are the people driving the new metrics, for these investments and strategies. So finally, and this will be, my question is, the cost of inaction greater than the cost of action, and I'll be very, happy to discuss also the role of women in this focus on ESG, but maybe at a later stage.
Great, thanks, Corinne. And finally, Morten, what's your perspective here?
Well, I'm going to try to stay in my comfort zone, which is I'm a financial modeler, so I'm a technician, and it's completely by accident. It's not what I aspired to be, but I know a lot about creating understandable spreadsheets that try to communicate a message in numbers and the business case. So what tickles me is the opportunity to join the sustainability community and try to do a better job of making the business case. And I think specifically moving from ESG scorecards, which I think are qualitative, to some extent quantitative as well, but we're not monetizing them. I think we have to be brave and take the next step to try to come up with an impact statement along the lines of a financial statement. So if you had a financial statement, and that's hard cash or income, plus an monetized impact statement, you could get to something which in combination, a fellow called Dirk Schoenemacher at the Bruegel Institute is calling the integrated value statement, or I think with one of the speakers this morning called full materiality. Then we suddenly have taken apples and oranges and created pears, right? We need to add it up. And of course, these are not real numbers, if you like. They're not real prices, because we live in this society where we seem to think if there isn't a market for something, if it doesn't have a price, then we can't value it. And that's what we need to get away from, right? We want to make sure we don't become Oscar Wilde's, wildest dream, maybe, but, where he said, become a society that knows the price of everything and the value of nothing. Or to Mark Carney's book that he came out last year called Values, where he laments that what was intended to be a market economy has become a market society. So we need to, as part of that more philosophical discussion, we need to refine value in other than something that we currently have a price for. And that's why I'm excited to try to take my spreadsheeting skills and my very hard-earned cash flow skills and try to build on those creatively to say, well, actually, if we add it all up, negative and also positive externalities, here's the real picture.
Fantastic. Well, thank you to our panelists for sharing those very thought-provoking points. Now, I suspect probably most of us in this room, we probably all agree in principle that taking sustainability into account in financial valuations is a good thing. But what does it really mean in practice? Is it most practical, as The Economist recently suggested, to start at least by focusing only on carbon emissions, or do we need to integrate a much wider range of sustainability factors into valuations? David, can I start with you here?
Yes, sure. So, what we have seen actually that when it comes to sustainability integration, mostly it's been done on the qualitative side. So basically, like buy-side analysts, they do like a financial model, they do financial assessments, and if all things equal, then they maybe decide on, based on some ESG factors. So kind of like there are two different things. So there's the one on the quantitative side and one on the qualitative side where actually ESG and sustainability falls into. But also, what we have seen in recently, that there's more movement towards kind of integrating sustainability on the quantitative valuations as well. So in this case, think about like when the financial analyst makes forecasts about key financial indicators in the financial model. Think about capital costs, operating costs, revenues. Then they can also integrate sustainability considerations at this level. So just to give you an example, like when they look at a company and they just want to understand how that company's market share is going to change, and therefore, as a result, how the revenues of that company will change, they can actually look at sustainability considerations as well. Also, moving beyond forecasting, when analysts and investors actually look at using DCF models, like discounted cash flow models and present value models, they can actually look at sustainability considerations as well and integrate sustainability considerations as well by actually deciding what should be the right discount rate used. Like the discount rate has a significant impact on the valuations of cash flows and then therefore the financial attractiveness of the whole business. And sustainability considerations can play a role. So, for example, a company that has a big environmental footprint might be considered more risky, and therefore the discount rate needs to be increased accordingly. But also, just to come back to your question on the carbon footprint, so I think carbon emissions is a good starting point. But certainly, I would like to see investors moving beyond carbon and including a wider spectrum of sustainability considerations in their investment assessment.
Great. And Corinne, do you have anything to add?
Yes, certainly. I think that, as David was pointing out, carbon emission was probably the easiest sort of beginner step, on the ESG. And for me, ESG is clearly more than, E for green. The S and the E are elephants in the room, clearly. However, I take comfort or hope in the fact that process is just as important as content. If the reason I say that is if we look at the appropriation process of the E, first there was an approach via exclusion, as you said rightly earlier. And that was kind of easy. I'm not going to invest into, pollution, fossil fuel, nuclear. There's a list of, exclusions. Until more data was made available, and more metric models and parameters, became available for some of these models. There was carbon registries were being developed, and data, etc. And then the process, interestingly enough, generated penalties, whether it was by the analyst, market analyst, or by the portfolio managers themselves. And so what I think is that it generated a whole new range of opportunities to rate the risk-reward metrics of the environment and the green. So what is interesting also is that as these carbon registers were being developed, there was also, and other initiatives, it was interesting to see civil society also become very much a stakeholder, an actor in this particular field. And it's not just the finance industry and corporations and policymakers. I mean, there's civil society that is sort of coming into the picture. And I'm liaising or linking this because of the S and the G. And so, interestingly enough, it's important to understand the role of civil society into, pushing this agenda further. And for me, I just think that the same is going to happen progressively. On the S, social or societal impact, and S, in a number of our circles, S stands for soft metrics, and I think that, we need to move it from soft definitions, quote unquote, or as perceived as being soft, by some of the analysts and market analysts and practitioners, and move into, as we said, cost-benefit analysis. And, as Morten pointed out, it's not because it's nature that it is free, and there are things that need to be costed. And again, as I said, this will actually drive the full positioning of society, and the G for governance, which in itself has known another kind of process of integration, because corporations, policy lawmakers have been, inducing some changes in the G, or the promotion of the G. So ESG, yes, is very much on the agenda, very much.
Great. And Morten, wearing your financial modelling hat here.
Well, the more lines, the better. No, I don't mean that at all. Less is definitely more when it comes to modelling. But I would say have fun with it. I mean, why limit ourselves to carbon? Be creative, and if nothing else, to discover what is not material. It's about materiality. But if you don't try to have however wild a guess it is, and your colleagues might laugh at you out loud initially, but I think that's the whole point of this exercise. Provoke a discussion through the numbers. Let's move away from just having the discussion without some numbers, because that can get a bit vacuous. But I think let's try to be brave, put some numbers down there, and see what happens. Get some pushback, if nothing else.
Great. And Jeroen, anything from you?
Yeah, so from my perspective, is carbon enough? Definitely not. There are a lot of other material aspects that actually have an impact on profitability, long-term success of companies, and therefore their valuation. So the way I would look at it is really like SASB also has a framework for that per sector. Think about what is important, what is influencing the valuation. And in the mining sector, that could be much more the environmental impact or the impact on local societies. But in the healthcare sector, it could be much more around product liability, or maybe bribery in Asia, what we have seen before as well. And then once we know what is material, we have defined what is material in the different sectors, ideally we translate that all into numbers, into cash, dollars, euros, Swiss francs, ideally in your discounted cash flow. Because then you have the best numbers to have that discussion with your colleagues.
It ain't cash, right? We can monetize it, but is it
Sometimes it will become cash. So take a company that actually we know is not positioned well for the energy transition. We know they have to transition. and therefore they need to spend capex in the next 5 years. We need to put that in the model. If they are a high carbon emitter, we know that probably at some point we get carbon taxes or other mechanisms, and then it will turn into cash, which you need to put into the valuation. But fair point, not everything can be put into hard numbers. Take good governance, or bad governance. Is that worth $10, $10 million, 10 billion? That's very hard. So what you can do there is to say, okay, we don't know the exact number. We do know it has an impact on the risk profile. Better risk profile, worse risk profile. So then, through the discount rate, you can include it there. So if you can't do it through the cash flow generation, capital expenditure, margins, and so on, then the other place in your valuation would be the discount rate. And then hopefully, one thing we know, it won't be perfect, but use some scenario analysis as well to see what the sensitivities are when you play around with it. But then at least by putting in all those numbers, you're forced to think about it. You're forced to have the discussion with your colleagues as well. And through that, hopefully you make the best investment decision as well.
So let's talk a bit more about the current state of play. And I'll come to you first on this, Corinne. How much progress are we seeing in convincing investors to actually do this, to actually take sustainability into account? And what impact can we expect from some of the recent or upcoming legislation, particularly in the European Union and other jurisdictions?
It is a complex question, to be honest with you, Ben. And if the conference is only an indication of the complexity of it all, it's clear that, as we said, we've seen two extremes, pushback and also embracing, with a lot of enthusiasm, the sustainability and ESGs into account. I will use, as a background note, some of the stats, impressive stats that have been proposed by the Swiss Sustainable Finance, SSIF. And they have done this since 2015, okay? And last year, if we look at the amounts that have been invested here, certainly in Switzerland, we're talking about more than 500 billion. ESG integration was, the #1 priority by all the investors based here in Switzerland, with a jump of 160% in terms of consideration. Exclusion was ranked 2nd, norms-based screening 3rd, ESG engagement 3rd, 4th, voting best in class, impact investing. So what I'm trying to say is that in some cases it's become mainstream, and demonstration and the stats demonstrate that it has an impact in terms of volumes and returns. In other parts, we've heard during the conference that a number of other managers or market analysts or stakeholders are pushing excuses and saying, well, ESG, it's not an alpha metric. I'm sorry, I'm not going to go along that route. So clearly, and we've heard Emmanuel Faber point out that, for example, for him, it was not, creating a new department within Danone, but it was ensuring that every single manager was becoming an ESG ambassador, and that being mainstream within a corporation. That was a governance matter. So we can see that the change in perception is really happening, but at different levels and on different timelines. What I think is interesting is in some of the things that we've heard, and pardon, but I use that word, some of the bullshitting that we've heard, where we talk about greenwashing, but it's really ESG washing de facto, because people are using the words. There's a hype. It's an alphabet soup, as we always hear, but there are some real things happening in the background. Yes, for example, I heard when the experts got together behind the EU taxonomy. Merci beaucoup. And that it was a way of delaying the coming on stream of ESGs, but it isn't. Emmanuel clearly explained that there was a concerted effort to bring together different groups, different expert bodies, etc., in trying to standardize and harmonize and speak a common language. So I see hope in that, in terms of where the current state of play is. At the same time, and we'll come back, we see this major pushback in the US, for example, around this notion of fiduciary duty, and I'll come back to that. In France, for example, it's been interesting to talk about the emergence of la loi called devoir de surveillance, and it is actually based on the UN human rights recommendation, which was embraced by the UK, finance community, etc., policy makers, but wasn't in France. And it was really interesting because when that law, devoir de surveillance, popped up, in France, people, companies came and said, well, what do we have to do? And there were no penalties at the time, so everybody dismissed it. Sorry to say that, but that was really the case. But when NGOs and civil society took on, for example, very recently, Total, under that loi de surveillance, devoir de surveillance, all of a sudden, it became reality, and now there are penalties attached to it. So what I'm trying to say is that the process, the momentum is there to change the perception of practitioners, market practitioners. You see what I'm saying? So there's a momentum. It's not a status quo. It's busy, not particularly streamlined, but things are moving. Different directions, but things are moving. Sorry.
Great. Morten, do you have anything to add on this one?
Well, I hesitate to say too much because I have limited data points, and I think I'll steer away from Jeroen's world of big corporates, and which I sense is a lot about potential negative sustainability factors and accounting for those and waiting for risk. But I do have two data points. One is from the impact investing community, and I was at a reunion at Oxford Business School a couple of weeks ago, and I came away in terms of state of play saying no one is actually valuing the positive benefits that these impact investments are pertaining to do, right? So I think in that sense, I understand why we're there, but perhaps we're missing a trick, and this is back to my opening statement. I think it's time to try to do an impact statement which is monetized. So I'll come back to that point. And through David and the IISD, that's how we've met, is I'm supporting their project on nature-based infrastructure projects, which is trying to prove the business case for investing in nature-based infrastructure as alternative to traditional grey or cement-based infrastructure. So, for example, instead of a water treatment plant that geoengineers would immediately think of building, you could renovate a swamp and gain the same water purification benefits, but also have some additional benefits of avoided flood damage in the future under certain climate change scenarios. So in that sense, I would say the state of play is that no one's doing it. But I can see the logic of trying to do it, and I think we need to get on with trying to do it.
Well, let's bring in Jeroen there. So is that fair to say that we're focusing too much on the negatives and not enough on the positives?
I think it's both. So of course you want to map the risks when you do the analysis, but you also want to look at the opportunities. So which companies do actually benefit from the energy transition, which companies benefit from other transitions to make the world a better place, to achieve the SDGs. So I think it's both. If I look at the progress we see as asset management, then a lot of progress has been made as well. So there is a lot of momentum. I think one thing that helped was what David alluded to as well, is the academic research. And at my previous role at NN Investment Partners, we also did academic research together with the University of Maastricht, which clearly indicated that if you include sustainability in your investment decision making, that at least it helps the risk return of portfolios being, or at least it's neutral, but very often there's also upside. At the same time, you do see that through time changing a bit. So I think between 2000 and 2008, the best companies on sustainability outperformed. Actually, after 2008, it was more the companies that were improving when it comes to sustainability. So no longer the ones that are already the best today, but the ones that are actually making an effort to improve, because that was not in the share price yet. So you saw some additional performance there. So I think all that academic research, where there are thousands of studies, helped investors be more comfortable that actually this is in line with fiduciary duty and we can demand this from asset managers. So in a lot of the RFPs we receive, basically our clients tell us you need to integrate ESG or else you don't get our business and we go somewhere else. So that compared to 10 years ago is really progress and really a change. So we see that. We also see that more on the retail side. So client-driven as well a lot. And then lastly, I would mention also regulation. So as if DR, for example, in Europe is really pushing the industry to do more, to do it better, to do it more detailed. So it's not always great. Sometimes it's very complex as well. Sometimes a bit subjective, but it pushes everybody in the right direction. And then last comment to make is, of course, globally, people move at a different pace. So I think a lot of countries in Europe are a bit ahead. In the US, it's a bit of both. So so if you look at New York, California, there they are demanding ESG or else you're out. If you then go a bit to the middle of the country or maybe Florida, and we'll come back to that later, then it's the opposite. So that's also interesting dynamics, a bit more politically driven there. And in Asia, we see also a lot of momentum. So it's maybe not as much highlighted here in Europe, but actually if you look what Singapore is doing and some of the other countries, actually a lot of momentum to improve there. So that's, good progress.
Great. And David, anything to add?
Sure, just a couple of thoughts. So I completely agree that actually ESG integration has been growing actually quite a lot in recent years. So we have seen as part of the Global Alliance for Sustainable Investing, ESG integration is about like $25 trillion US, assets under management that are following ESG integration strategies. And also, as Corinne just said, like in Switzerland, it's kind of like the same numbers. We are, same trend. We are saying like 1.3 trillion Swiss francs assets under management are following ESG integration. So, but then of course, we can ask, what is the quality of that in ESG integration? So what is the different methodologies that are behind this? But I think that's a different discussion. I mean, what's important is when we talk with progress at this stage is really that ESG integration is becoming mainstream. Like I remember, like 5 years ago, when we looked at sustainable investment numbers, it was negative screening that was actually took the biggest part, and that actually for me is like the simplest way to do sustainable investing, and I'm very happy to see that actually it's not the biggest and the most popular sustainable investment strategy now in 2022. When it comes to kind of like the EU legislation, so certainly when we look at the EU Sustainable Finance Action Plan and some of the corporate sustainability data disclosure requirements, they are certainly supporting ESG integration, because what's very important is when you do ESG integration that you actually have the necessary data points to actually integrate into financial valuations and to actually decide, for example, when you are changing the discount rate, as should it be changed by like 10 basis points, or should it be changed by 5 basis points? And I think for that you need to have the right data points.
Now there's an elephant in the room, and its name is greenwashing. How do we get to the point where there's adequate data and there's adequate reporting, so it's easy to actually identify when sustainability claims are made and aren't justified? Jeroen, can I start with you on this?
Sure. So the good thing is transparency is improving, partly driven by regulation as well. So take, for example, SFDR level 2, which comes into effect 1st of January. With that regulation, investment funds need to report how much % of their portfolio are in sustainable holdings. So then it becomes very transparent for clients to say, hey, you're calling yourself a sustainable fund, but you only have 10% sustainability inside. So I think transparency will increase a lot, and that will also cause some debate and people to improve further. So I think that's great. Is that perfect? Definitely not, because the regulator is also saying what you call sustainable, roughly you can make up yourself. So every asset manager can come up with their own methodology. High level, it needs to contribute to E&S, good governance, and do no significant harm. So there are some guidelines, but we already see in the market that for some investors, the MSCI World has around 60% sustainable holdings, and for other asset managers, they put it at 20%. And that's quite a big difference. So the methodology will be different. So will it be perfect? Sadly enough, it won't, but it will be a good starting point. And there again, from that point, you can challenge asset managers to say, hey, to classify a company if they contribute to the environment or to society, you basically say it's fine if it's only 20% of revenues, for example. And other asset managers say, no, we use a 50% threshold. So more than half of the revenues need to be sustainable or good, and only then we count it as sustainable. And I think in the new year, that will create even more transparency once the methodologies become transparent. And in the end, I think that will improve the market further. So I think some good steps. You touched upon data. Data is still a challenge. Take ESG scores, for example. I think we all know the MIT studies that correlations between different data providers are very low. So from that perspective, sometimes as low as 0.3. So from that perspective, in my view, ESG scores, I compare to sell-side research. It is an opinion. This is not data, it's an opinion. And opinions are great. And I would like to take those on board for my investment decision, but treat them like opinions, don't treat them like data, because they all have different methodologies. I mean, how do you weigh child labor, labor rights, human rights, climate? I mean, what is 10% worth? What is 20%? Yeah. How do you put that into one number? I mean, that's very subjective. What we always try to do is, let's see why a company is scoring well or not well, and use those arguments to integrate into your overall assessment. And that will improve as well. So the data is also not perfect yet, but never a reason not to do anything. You just need to deal with it properly.
Okay, and David, what do you think on this?
Yes, so I certainly think that greenwashing is a much more dangerous thing to do in 2022 than it was, let's say, 5 years ago. I mean, as we have seen, the offices of DWS were raided, I think, like 6 months ago or something like that, on DWS, so which is basically a subsidiary of Deutsche Bank. Because of greenwashing allegations, and similar thing happened with BNY. You know, BNY was charged by the SEC again by misstating some of the ESG credentials and integration strategy. Also, Goldman Sachs is being investigated as well on greenwashing. So I think all this is showing that actually greenwashing is certainly something that we have to be careful about, like investors have to be careful about, and I think the message has come across. I think there's certainly more awareness of litigation risk as opposed, when it comes to ESG integration. I believe that in terms of bringing clarity and decreasing the risk of greenwashing, the sustainability disclosure standards going to actually play a role, and some of the mandatory disclosure requirements as well. But I think at the end of the day, investors have to be very clear, and asset managers have to be very clear actually on how they are integrating sustainability considerations.
Great, and Corinne?
Absolutely, I'll second this, saying greenwashing is a two-edged sword. I mean, I'm doing some advisory work on conseil scientifique on governance matters, and I absolutely draw people's attentions and, civil society representatives and administrators, and about, on their responsibility when it comes to declarations and reporting, as you say, that cannot be measured or transparently documented. And I think that it might be tempting, and because it seems to be easy and you can play with words in your reporting, but the backlash can absolutely be devastating. And also, I would say that NGOs don't necessarily have, a negative agenda, but if you serve it on a silver tray, without the transparency, without the metrics, without this, you are bound to be challenged, on any declarations that you make or any reporting that you make. And the impact via social media can be absolutely devastating, for any company engaging into that kind of, greenwashing and, sort of not transparent kind of reporting. So it's very, very dangerous.
Mm-hmm. Absolutely. And Morten, any thoughts from you on this?
I've been learning since yesterday morning, and I think maybe we should call it ESG washing, because it's that label, isn't it? And what I seem to have been hearing from a number of speakers is that ESG is maybe not a very good label to use any longer. And if I'd refer you to the Swiss Sustainable Finance Market Study 2022, it's very readable. I thought that was very educational. But it has this expression: we need to get away from the current catch-all of investments that integrate any ESG factor, and that's why we're going to get to 100% ESG integration on that basis, which means it's meaningless. So I think, to me, the answer is about narrowing the focus, or upping the ante, if you like, changing the definition. And it's all evolving terminology, but I'm sort of thinking that the word impact is maybe the one we should start talking about. And impact investing is at the far right-hand spectrum of the, quote, ESG considerations. So I think we should try to stop using the word ESG, talk about impact, and that has the intentionality that's understood behind what you're trying to do, and just raise the bar, right? It's time to raise the bar. I understand why we are where we are. We've had to get to here, but it's time to change gears.
Great. Yes, maybe we can come back to some of those points when we have the discussion, because some very interesting points there. But firstly, there's been a backlash, as Corinne has said, especially in the US, especially in certain states, against the whole concept of ESG. Clearly, many people object to the idea of considering anything other than factors around financial performance when it comes to valuing companies and making capital allocation decisions. So, Corinne, I know you're going to talk about this. How can we navigate around those objections?
Yeah. I fell off my chair. I'm going to read to you what popped up on my radar screen. It was dated August 23rd, and this is Governor Ron DeSantis, the very famous governor from Florida. And the title is Eliminating ESG Considerations from State Pension Investments. And it reads, corporate power has increasingly been utilized to impose an ideological agenda on the American people through the perversion of financial investment priorities under the euphemistic banners of environmental, social, and corporate governance and diversity, inclusion, and equity, said Governor DeSantis. And he continues, with the resolution we passed today, the tax dollars and proxy votes of the people of Florida will no longer be commandeered by Wall Street financial firms and used to implement policies through the boardroom that Floridians reject at the ballot box. We are reasserting the authority of Republican governance over corporate dominance, and we're prioritizing the financial security of the people of Florida over whimsical notions of a utopian tomorrow. I hope you enjoy this one. So the backlash is real, and it's done in the name of fiduciary duty. This has been on my agenda as well and on my radar screen for quite some time. And in the name of fiduciary duty, we are pushing, or some stakeholders are pushing, the notion of value for money as being the line in the sand when it comes to good investments. And so I thought it was really interesting that Patrick Audier in his opening speech, spoke so much about the impact of fiduciary duty and what it means. I think what is interesting is that the definition of fiduciary duty, unlike some of the things that were said earlier when you can come up with your own definition, it's not a definition that you can play with. There's an official definition, for example, in the in the US, and it is the responsibility of the Department of Labor. So it's not something that a state pension fund can adjust. You see what I'm saying? There are some rules and regulations, and so, it is something that is under control, all right? So probably the next think tank or the next working sessions could be around this notion of fiduciary duty, and impact. As I said, we talked about it, but we probably need to move, collectively towards new paradigms and new definitions, especially when it comes to fiduciary duty.
Well, it's a shame Ron DeSantis isn't here on the panel to respond to some of those points, but maybe he's got other things going on. But instead, Jeroen, how can you approach this? Because what are you meant to do as an asset manager when different states within the same country are taking effectively opposite positions when it comes to fiduciary duty and how investors should behave?
Yeah, so from my perspective, a lot of these ESG factors are financially material. So they're actually in line with fiduciary duty. So I would continue to include them to get the best financial result for those pensioners he was talking about. So actually stripping out ESG might be costly for those pensioners if you ignore basically financial material aspects. So from that perspective, and my sense is a bit that the state of mind might also still be around what was 15, 20 years ago sustainability, which was simply what do we exclude? And there you can make the case that sometimes exclusions might not be, let's say, fully aligned with the financial returns. And I think that is being confused, that state of mind, with what is today called ESG integration, which really helps you make better investment returns and better investment decisions. So from my perspective, I'm quite relaxed in terms of, we should always integrate these ESG aspects when they are material. And hopefully we will also move to a little bit less politics and a more fact-based approach to this discussion.
Yes, and actually as a development over the Ron DeSantis declaration on fiduciary duty, I think it's interesting to connect it also to the position or the statement made by Mr. Hildenbrand representing BlackRock yesterday, and sort of pushing back on the fact that pension funds would not be allowed, to follow ESG rules, integration, impact, notion. I'd like to bring in consideration or some of the discussions that I've had with Canadian pension funds. And what they've done is, instead of taking a top-down approach, more of a bottom-up approach, and they have put together sounding platforms with future retirees, people who are in their 30s today, and saying, what would you like us to do? What are you expecting from us? And to second what you just said, they said exclusion is not enough. Show us more. Show us that you're actually doing investments, with impact. And so I think that goes back to this notion of how do you connect and who are your end takers, your off takers, your consumers. I mean, we'll come back to that. But that's actually one of the interesting developments, around this notion of fiduciary duty.
Okay, and David, any thoughts from you on this?
Yes, I mean, I think the Florida case has been well covered by the panelists, but I also want to point out that that was also only part of the backlash. So basically, we also had backlash by the states of Texas and West Virginia, which were basically saying that public investors and then public institutions cannot invest into a range of banks and financial institutions that boycotted fossil fuels, right? So that was also part of the discussions, and one of the banks were also Credit Suisse, right? So I think that's also and very interesting for me to see this backlash, and like again the reasoning they give was the same what Cory mentioned, that basically these financial institutions, they use their influence to actually advance their social and political agendas, basically. So, but when you look at some of the numbers, like for example, I saw a report from Morgan Stanley, and they showed that actually 85% of all investors in the U.S. actually are interested in sustainable investing, and 86% believe that actually sustainability can lead to higher financial returns. So when I look at these numbers, this 85% or 86%, it clearly tells me that the sustainable investing goes way beyond party lines, right? So otherwise we would see like a 50%. So that's one point. And also, I mean, I think outside of the US, we are clearly seeing a very strong trend in sustainable investing. As I mentioned, like earlier, like we have $40 trillion assets under management are following sustainable investment strategies. So certainly, it's not about political, like ideological or political lines. So it's certainly it goes beyond. And I actually see two problems with forcing financial institutions to lend to fossil fuel companies, for example. One is according to the International Energy Agency, we cannot have new investment in oil, gas, gas, and the third was coal development projects, right? So if you want to force financial institutions to do this, that would obviously be a breach of this. Second, by forcing financial institutions to lend, to fossil fuel developments, you actually also maybe breaching, like pushing them towards something that maybe is not in line with the risk assessment. So maybe actually some of the financial institutions, on this list, they decided not to finance coal or gas because simply it's not in line with the risk assessments. And so for me, this whole discussion is so backward in a way. And I certainly hope that this is just a U.S. political discussion and it's not representative to the global state of sustainable investing.
Great. Okay. So just keeping an eye on the time, but we've got a few more things to run through. So we're clearly going to need some innovative approaches here to integrating sustainability into financial valuations. So I'll ask the panelists if they can share some examples. Morten, can we start with you on this?
Sure. And I was deliberately skipped before. As a modeler, I don't have a view on that previous question, except as a retail investor, I'd hope that if Jerome's right, his fund will perform better than the Florida pension fund. And that will hopefully tell people the story. Yeah, exactly. So innovation on modeling, it's very few data points. My general sense is this is frontier stuff. It's not theoretically new. Cost-benefit analysis has been around for decades and decades. So the economists have, gone, "We told you so." But we've become this market, not just economy, but market society, where we've sort of become, know the price of everything and the value of very little. So we need to correct from that. And the way David and I met each other was because the IISD convened a book sprint, which is to write a book in a week on modeling for sustainable development. And I was there to present the spreadsheet geek side of the spectrum. And then you had some really clever economists doing systems dynamics modeling and geospatial modeling, and we tried to bring all that together to have an integrated approach to modeling not just the cash flows, the financials, but also the social balances and the environmental balances. And since then, in the summer, I joined the ISD to support a program that's funded by the Global Environment Facility and MAVA to carry out 50 feasibility studies for nature-based infrastructure over the next 5 years. And this is to prove the business case for nature-based investments which you know is currently not there, if you like. So in terms of innovation, we're taking a systems thinking approach. System dynamics modeling is not just the lowly spreadsheet and the sort of financial statement end where I come from, but it's trying to get the science right. And you know, so I'm part of a team where there are these team members who know all this excellent stuff around all the externalities. And then I guess my small contribution is to try to land that in and communicate it through a spreadsheet, communicate through numbers to potential decision makers, right? Because I think that, you know, we forget that we have a communication challenge. One is to sort of have the scientists who and all the clever programming, but we then need to package this as a quote fully fledged business case. So I think that's what I can contribute in terms of innovation, is what ISD is calling the sustainable asset valuation methodology, or SAVI, and this particular program.
Great, thanks, Morten. Jeroen, anything on this?
Yeah, I would mention two things. One that excites me is more the satellite data, location data of where firms have exposure, where firms are positioned, combining that with overlays for, let's say, more the risk of droughts, flooding risks, and so on. And through that, get a much better grasp on risks for the companies we invest in. So that type of new data sets, I think can really help strengthen the overall analysis. And secondly, I would mention, for example, natural language processing, so more AI type of technologies, which you could, for example, use more on the upside, so the positive side, to say, okay, which companies actually have exposure to the Sustainable Development Goals, are aligned to the SDGs in what they do. And through NLP, you can look at thousands of securities at the same time and create different angles compared to the more traditional screening tools that are out there. So especially for the ID generation phase in investing, new technologies like NLP could add as well.
Great. Okay, David?
Yes, I mean, most of the things were already said before me, but I mean, I certainly would like to see, when it comes to ESG integration, that we move from risk and we also include like the positive side more. I mean, it's already happening to some extent, but I think definitely I would like to see like avoided cost opportunities being much more integrated into financial valuations as well. And I certainly agree about the AI approach as well that was mentioned earlier. I actually saw the prospectus of a fund that actually uses AI methodology to scan through annual reports of companies and looking for some keywords on equality, inclusion, and invest accordingly. So basically, the whole idea is that they can determine kind of the corporate culture based on annual reports. And the companies who are more inclusive are doing better. And I actually was on one of these, like the roadshows of this fund, so I don't know how they are doing, but I would certainly would like to check it out. So.
Great. And last but not least, Corinne?
The company is doing well, the fund is doing well, because I know them, yes. No, but I know them. And I'm part of also this nature-based initiative, you know, alongside David and Morten. And I think that, you know, as I said, my role as a dinosaur is to sort of bring to the table, former cost analysis metrics and models and, you know, other metrics and references into this discussion. So that's part of the innovation.
Maybe 1 minute to at least bring some nuance to the NLP. So yes, it is a great technology. What I have noticed already is that companies reach out and say, hey, what are the words we need to pay attention to? So the downside is that they're going to put those into their annual reports and on their website, so just to score better. So be mindful of that, of course, as well, when you interpret these data sets.
Okay, and So before we get to questions from the audience, let's just finish off by talking about the future outlook. And in the interest of time here, I'm going to ask everyone to keep your answers to 1 minute or so at the most. But Corinne, can we start with you here?
Yes, I'll just be real quick, but I promised you a little bit of information on the role of women. And here I'm quoting a research piece done by WEF, the World Economic Forum. And there's an increasing role for women in when it comes to investment decisions. It is interesting to note that women control almost half of all US estates valued at more than 5 million. Of the 41 trillion of intergenerational wealth transfer over the next 4 decades, women will inherit 70%. 40% of American millionaires are women, and by 2030, roughly 2/3 of private wealth in the US will be held by women. And what is interesting is that when they make decisions, they are the primary decision makers, and they will actually fire the former advisors, and they will concentrate on ESG as metrics for their investments. And I can go on and on with these statistics. I'm happy to provide the references of this particular study, but I think that there were a lot of women on the panel. Don't get me wrong, we heard some, ESG washing, but we also heard a number of women taking on this new challenge, with great, great intensity. So I think there is something to be said about that.
Great. Okay. And David, quick thoughts from you?
Yes, I just want to echo some of the points I said earlier. So I think we are seeing a momentum in sustainable investing, and I think it's continuing to be built. So we see actually going from 40 trillion assets under management today, we're going to go to 160 trillion, which is like almost 100% integration. But I think what's very important is that when we have quantity, we also look at the quality a little bit more and try to increase the ambition, the sustainable ambition of some of these ESG integration methodologies that we see in the space.
Great. Morten?
Yes, the one thing we know for certain is that all models are wrong. But that's okay. That shouldn't mean that we don't try. And if they're all wrong, what then matters is that we're consistent, so that our different models are consistently wrong, and so that we choose, in that sense, the least bad investments. So just because they're wrong, just because we can't tell the future, doesn't mean we shouldn't try. It's not an excuse for not trying.
That's refreshingly honest from a financial modeler. And finally, Jeroen, any thoughts from you?
Yeah, maybe 2 quick thoughts. One, in terms of the future, what we notice is that every new generation is more interested in sustainability than the previous generation. So that, I think, is a great development for the future as well. And then secondly, we all need to get better. I'm also active within CFA Institute, so the Global Institute for Investors. And what we notice there is that in the last 5-6 years, every year, the content of sustainability in the normal mainstream financial education is increasing. And we even now have dedicated modules on ESG as well as on, for example, climate. So also from an educational perspective, more and more is integrated in the mainstream, and more tools are available for people to educate themselves and to progress further. So 2, I think, positive trends.
Thank you very much. So let's have some questions now from the audience. I just ask that you wait until the microphone arrives with you so that the live stream can pick up. If we start with the gentleman on the front row.
Thank you very much. So if I may summarize just before asking my question, so do we agree that we move towards like a terminology from ESG to impact, maybe, and that the valorization of this impact might be not only like a monetization, but could be valued like differently? So that's interestingly my first question. And second question is, like, based on that, what would you think of an idea of a marketplace to put together what I understand, you would promote rather positive externalities than negative externalities. Please.
Great. Okay, you get 2 questions because you were brave enough to sit at the front, but everyone else, please keep to one.
I'm sorry.
Corinne, do you want to start with those?
Yes, I think that was a great summary. Thank you. Yes, I think that the idea of a marketplace is certainly interesting, or at least a think tank, or something to move the conversation. Looking to positive externalities is clearly the way we are doing, and we are promoting, and we are challenging the status quo today. It's not necessarily easy. I can just think of one, when I was the CEO of this private equity fund on infrastructure, I insisted, for example, on a positive tax benefit of projects, positive externality, for governments to consider. So I think, yes, that's the way forward, if I may say so. So I'd be happy to support that initiative.
Thank you.
Jeroen?
Yeah, given that we're on a panel and we should have a bit of disagreement, I'm going to partly disagree with the summary.
Okay.
So I would say ESG integration and impact for me are different concepts. So integrating ESG into your financial decision making and into your analysis makes the decision better, more complete approach to investing. I see basically 3 layers when you think about investing. You have the exclusions layer. What are you not investing in? On top of that comes the ESG integration layer to take everything on board from an ESG perspective that is important material for your decision. And then the third layer on top of that is potentially, can differ per fund, do we also have sustainability goals on top? And that is for me the impact. So funds can do different things of those 3. Some do only exclusions, some do exclusions and ESG integration, some add impact on top, but I see it a little bit as different concepts. Do I hope that we all move to the impact area as a society? Yes, I hope we move there. But I do see it a little bit as a nuanced difference between those 2 terminologies.
Thank you.
Great. Lady in the 3rd row.
Hi, my name is Sarah. My question goes to Jeroen, and it goes in the same direction. So you mentioned that we have positive and negative impacts, financial impacts on companies that will have an influence on the valuation. What's your thought about if a company is doing good, meaning having a positive impact on the nature, but not on the financial, not on a cash flow level? Should it also be integrated in the valuation?
Well, so ideally, yes. The question is a little bit coming back to the earlier discussion, can you put a number on it? If you can't, then at least if you have a positive impact, you're less risky. Then I would reflect that then in the discount rate. To have a more favorable discount rate because the risk is lower, because you're treating the environment or nature better. So ideally, I turn it into a number. If not, you can use the discount rate. And on top of that, if your fund really looks for nature-based opportunities, that's an additional reason why you would invest in that security versus another security that doesn't have that exposure or that positive impact. Hope that answers the question.
Can I just add to that? I think that was a great question. Thank you. And I think it highlights kind of the risk approach to this, which is what discount rate you use, and whether you try to attach an explicit impact statement value to it. So I think we should try to do both, right? I think
Some funds will do both.
Yeah, but I guess you start with a company, right? It'd be the company would want to say, look, we have this externality as a benefit. Let's attach a value to it, and then people can discount it or ignore it or what they want.
Perfect, thank you.
Great, okay. Could we go to the gentleman over here in the 2nd row?
Thank you. My name is Mark Helly. I'm from Nature Finance, which is being launched tomorrow, in fact, tomorrow morning. I have 3 questions. I assume you want me to pick one of them.
Let's choose the best one, and then maybe we've got some time.
Not sure it's the best, but I'll pick one of them. And I just want to push back a little bit on what seems to be the assumption that with the perfectly legitimate critique of ESG performance and reporting, that the net result will be move towards more robust standards and reporting. And I'm not sure that's entirely justified. So there are two ways you can go. One is towards impact and better measures of a company's impact, but the other is towards saying, oh, this is more trouble than it's worth. And in a context, an economic context of downturn and inflation, how confident are you that actually the critique of ESG will drive the field forward rather than backwards?
Who wants to take that one?
I'll take it because I think I was kind of pushing the other side of that. But equally, I realize I'm sitting here in an ivory tower, in a think tank tower, and this can be just more trouble than it's worth. You know, when I was at this impact investing reunion, this was exactly the answer I got from impact investors. Say, look, it's difficult enough. You know, if we're going to start to layer this sort of analysis on it, then at the moment we just don't have the bodies.
Maybe just a quick reaction for me as well. So when I talk to S&P Global or like MSCI, who are like one of the leaders in the ESG space, you know, they certainly understand that they have to move towards impact, and that's something that they are working on. I mean, based on what they say currently. So I actually expect to see some developments in that area, and I mean they actually spoke about this publicly several times as well. So it of course is difficult to do. It takes time, and probably when they come out with something, it will not be perfect, but it will be a step into the right direction.
Maybe just to add to that, what I do, where I worry a little bit is if you think about the spectrum of sustainable funds, from doing nothing to all the way to philanthropy, then I think the closer you get to philanthropy in a world where there's a lot of cost pressures, inflationary pressures, that bit might be a little bit at risk or at pause. Because people say, well, as long as it is aligned with the financial returns, I'm fine. When in the area where you might have to give up some financial returns, I think there you might see the pressure, well, in the coming period. Hopefully it's a very short period. But yeah, that's all uncertain. So there I do sense a little bit of risk. At the same time, I still see a lot of clients that really want to move towards the impact side. Yeah.
And if I may add, for being involved in a number of blended finance with philanthropy, I think that when you have seen negative returns in some, products, financial products, the fact that there is an impact and a positive externality on some of the investments that are being made is also seen as a plus for certain investors. So I agree with you, it's a very fine line to walk. As I said earlier, there was this PwC report that said, if I'm losing a basis point, no, I'm not interested in ESG. That was 81% of the fund managers responding. It's, it sends a little bit of a shiver down your spine, but I still think the market, the investors are walking with their feet and choosing and just really embracing that notion of impact, positive externalities, if I may say so, from my own experience today.
Great, okay. Lady in the fourth row there.
A question from another dinosaur. My daughter is calling me a dinosaur also. What is your view on the companies, so long-term companies that have been extremely sustainable financially, but who, because of the nature of their business, the mass producer of unhealthy goods, or of short-lived goods, will always have a detrimental impact on nature, on people. I'm thinking of the Coca-Cola, of the fast fashion industry. Those companies will, despite their efforts, will never produce credible metrics on their ESG impact. So how do you perceive them? Excluding them is not an option, I agree, but what's your view on those business models which are by nature unsustainable?
David, you want to take this one?
Yes, I can start. So actually, basically, I mean, if I'm an investor and I'm doing ESG integration, I would simply price this in. So basically, so what I'm hearing is that, like for example, H&M or like one of some of those brands, then maybe there can be like a regulation on waste or whatever. That's going to be like a financial penalty for these companies. I mean, like we are seeing it's the same for Coca-Cola, for example, like the plastic bottles. That like if we get So that would be one risk that I see as an investor when investing into these companies, and their actual methodologies to actually measure, what actually, how you should be reflecting this in financial valuations, for example.
Yeah, maybe to add to that, also I think important to realize is that as a shareholder, you are an owner of that business as well, and you do have some power. So for companies or sectors where it's not perfect and really a bit unsustainable, you would also go into discussion, engage with these companies to hopefully get them to reassess a bit their business model and to see how we can improve that business model. I mean, there's no guarantee, of course, but you need to challenge those companies. You need to engage with them. You need to maybe during the AGM vote in a certain way. As a shareholder, I think you have that duty as well. And again, financially, that could be a win-win as well, because if that company becomes more sustainable, then it hopefully also becomes more worth more longer term, because it has a better sustainable business model. So engagement, I think, is a key one to consider as well.
And I would add that I think after COVID and with the current compounding of crisis, energy prices, etc., customers are voting. I mean, with their feet, choices, foods that you choose, investments that you make. And I think it is going to have a long-term impact. I think we haven't seen it yet, but I think it's coming. It's happening. So to add on to what you've just said, I think, voting with your feet and voicing, your choices becomes actually quite important.
Great. Any other questions? Right at the back over there. Yep.
Thank you very much. Michael Diaz from Qperia. Thank you for sharing your insights with us. Seizing the opportunity to have that panel, one question. We were talking a lot about unsystematic risk that we can diversify. What do you think about systematic risk, which we cannot diversify? And would you say systematic risk will go up or will be worse in 2050? And what factors will affect that? Or will, let's say, when we take climate change will not affect systematic risk, which would mean that we still have quite some opportunities to diversify. So what is your opinion on the difference between unsystematic risk and systematic risk when we take the portfolio theory?
Okay, interesting question. Who wants to take that one? I think David does.
I mean, I can try this one. So I mean, can you give me an example for ESG systematic risk? Because basically for me, that's a question. Because I think most of the sustainability-related risk I can think of, they would fall under unsystematic. So if you can give me one, I mean, then maybe then the panel can give an answer as well. Because for me, systematic risk is more like at the macro level, right? So that one would fall outside of this panel discussion.
Well, one example could be that in 2050, maybe we will not have the same GDP, not the same economic growth. And with that, as a result, we will not have the same earnings possibilities of the industry as a whole. So that could be one possibility. Robert Eccles from University of Oxford, he said, in his understanding, systematic risk is underestimated. I'm not sure. I'm really not sure if it's underestimated or if everything is, let's say, from a perspective of financial markets, we would say, no, we don't see it an influence on systematic risk with regard to climate change. One influence would be that we do not have the same economic growth in 2050. That could be one. So an economic crisis, let's say the scenario would be a collapse of climate economic crisis and not the same growth perspective. That could be one scenario, but I'm not sure if that will happen. So nobody is, but I think, shouldn't we talk about systematic risk instead of unsystematic risk?
Yes, but I mean, as you said, you cannot diversify away systematic risks, right? So I mean, I guess when it comes to ESG integration, you are basically dealing with unsystematic risk, and so it would not. So that would be my response. I don't know whether somebody has something. Yeah.
Yeah, maybe climate change can, of course, become systematic in the long run. I think that the challenge, what I see, is more long-term versus short-term. That sometimes climate change is something that happens far, far in the future. Hence, people think then in their head, and then they say, okay, so in my time horizon, it should be fine, so I don't have to worry about it. My answer to that is always, it's incredibly hard to judge when it will hit you. And we are already seeing things like climate change hitting certain areas across the globe. So this short-term versus long-term mindset, I think, is a bit of the complication and the challenge we face as an industry. And I think that's a bit of a dangerous discussion, because these long-term things can actually be hitting us tomorrow or next week or next month. So for me, you need to take them into account today.
I think we've got time for one more question. At the back there. Oh, so, well, let's go to the back, and then maybe we've got one.
We do too.
We'll try and do two.
Yeah, hi. With regards to the expression ESG integration, that I think is very imprecise, create a lot of misunderstandings, including in this panel, actually, and many of the panels I've seen during this conference. Because some put ESG risk integration into it. I think that's typically for the asset managers. And some put impact in it, which comes more from the sustainability side. And this is a little bit problematic in some discussions. Shouldn't we once and for all split ESG risk integration from a dual materiality perspective out of that expression? Because I think we will have much better discussions. And I also think that maybe even US governors would have come to better conclusions if they understood this difference. I think this is a huge thing. So maybe the US governor actually takes the right decision from his level of understanding. And somebody needs to help him out a little bit here. Do you agree?
I would fully agree that it's completely messy in terms of terminologies. I would correct a little bit to say, as an asset manager, at least representing the asset management industry, maybe in this panel, I look at both upside and downside. So I would a bit disagree that we only look at the risk side when we integrate ESG. It can also be an upside and also help revenue growth or better margins. But I think the distinction is more between impact and more the material integration you do when you do the analysis. And there I see a lot of confusion in the market when people expect impact, but they call it ESG integration, or they call it ESG integration while they're actually thinking about exclusions only. And that is a lot of miscommunication in a lot of discussions, probably including the one in the US you mentioned as well.
Okay, and then last but not least, gentleman in the second row.
Thank you. When I heard what I just heard, I feel very good and I feel scared, right? I feel good because it looks like the momentum is there. Younger generations are pushing, so that's good. But next week I'm going to go see LPs or investors. I'm going to try to raise money for projects which are hopefully fully compliant with KPIs, measurable, etc. And many people are going to say, hey, you know, you show 12% IRR, and without your ESG thing, it could be 15. So what do you do? So my question is, don't you think that those who could help are the governments? Don't you think that the regulations could help massively? Because at the end of the day, you know, we see that now governments keep subsidizing, you know, the gasoline, while the best way to make sure we consume less would be for the gasoline to be more expensive. We see the coal power plants being back to the game, et cetera, et cetera. So So it looks like, you know, how politicians, I'm not going to qualify those politicians, but the politicians bear, you know, an enormous responsibility, and that they don't want to take it onto their shoulders.
It's a great question. Corinne, do you want to take this?
I think this is a really interesting point. And I think part of the debate has been short-term versus long-term perspective. And, you know, politicians are clearly on a short-term, you know, thinking on more of a short-term basis and re-election, and, you know, we all know that. I think short-term has also been characterizing performance reviews in the financial industry, in the pension fund industry. I mean, portfolio managers are remunerated, you know, on their short-term performance metrics. So it's really difficult, you know, to push the envelope towards long-term. That's the first comment that I would like to make. When it comes to, you know, fundraising, and I think, you know, my experience is that you can play with numbers. You can play with all these, you know, pricing externalities, you know, cash flow, DCFs, and, you know, all these things. We know that. I think that the whole debate is actually almost philosophical. And I hate to say this because, you know, I'm a financier by trade, but I think that it's really important to put it in perspective. I don't think there is no quick solution. And, you know, as we were all saying, it's layering that really will get us to the point of, you know, what is it that we're trying to do? Again, are we capable of moving outside of our comfort zone, the value for money, the strict metrics in terms of financial returns? Or are we capable of elevating, you know, the debate and saying, okay, what is the value from, you know, for money, people, planet, and profit? I mean, that's really bottom line what we're trying to do with, you know, this panel, at least. Yes, please.
Yeah, just one point quickly, because I know I'm conscious of time. But I mean, I think governments do have a role, and I think policy definitely has a role in all this. But I think it has to be more on the standardization, or like the taxonomies, for example. So what we are seeing at the EU taxonomy level, that, you know, that brings clarity to the market. That's what actually we need, I think, or like SFDR, etc. So I think that's where I see the role of the government and policy, and less so intervening of what investors should be investing and what they shouldn't invest. And just about, as you are fundraising, I mean, I talked to some fund managers, and they said that, David, I'm not really sure that ESG has a positive impact on financial performance, but for fundraising, it's amazing. So I guess that's also something to think about. Yeah.
Okay, Morten, did you want to finish?
Oh, just to finish, I have a question for all of you, which is that if any of you are engaging in monetized impact statements, or aware of anyone who is, or if you come to do it, try it in the future, please get in touch. I'd love to know. I just want to know who else is trying to do this out there. Thank you.
Great. Well, that's all we've got time for today. So thank you very much for joining us and for being such a great audience and asking many probing questions there. So thank you to the IISD for hosting us. And of course, thank you most of all to our 4 brilliant panelists. This is the last session for today, but the good news is I understand there's some cocktails downstairs. So I hope you can join us there and continue the discussion. Thank you very much.